Welcome to AllGen Academy. So today we're going to talk about one of the other components of financial freedom, which is the income sources once I get there. Okay, and we've defined financial freedom in a different video. But if you've done planning with us, okay, I'm going to refer you to the trail map. There's that circled area there. It's not the income source calculation, but this is where in your trail map it's taken into consideration. Right. Okay, yep. And we'll tell you why in a second. But income sources in financial freedom affect how much you have to save. And that's what you see in your trail map, because the more income sources you have, the less technically you have to personally save and accumulate. Okay, and we'll talk about what that looks like. So that's what I just finished saying. Reliable income streams provide stability. Okay, the only concern is if income sources, as you'll see them here in a minute, happen, you don't necessarily control, are they adjusting for inflation? Is it enough to keep up with the cost of living? Okay, so not that income sources are bad, that's just one consideration when calculating your future, financial freedom numbers.
That's right. And just to kind of point at the reliable income streams provide stability, is a lot of times they are a certain amount every month that just keeps coming every month. However, a lot of times you can't pull a large chunk from that. Right. You're only getting that income stream. So while they do provide stability, they don't really provide that flexibility.
Right. And we'll talk about that. And here's why. If you look at the different types of income sources, typically we're talking about Social Security benefit, pensions from private companies or government pensions, annuities. Here's an income source that you can control a little bit, is earned income.
That's
actually a job, okay, in retirement or financial freedom stage, or accumulated assets. I've saved this much, now I'm going to start pulling for it and creating an income source for myself.
That's right.
Okay, and here, interesting chart here, as you look on the right there, Jason, you see the breakdown of income sources versus investments and personal savings.
That's right, yeah, and actually, something to keep in mind as you look at this chart is this is the average 65-year-old and older. So, not that we aspire necessarily to be the average. So don't look at these percentages from the standpoint of kind of what you think you're going to need, what percentage that you need, but more so in general, this is where people pull their income from retirement. So Social Security, you see, is about a third. And then if you combine kind of your retirement accounts, pensions, those types of things, that would be 20% on its own. But if you combine that with your investments, that's about a third.
Right.
And then you have your current employment earnings, which is the other third.
Right, which is a job. What this doesn't break down, it puts retirement personal accounts together as far as 401ks, but also pensions, private pensions.
Right.
And historically, over the last 20, 30 years, private pensions have been diminishing.
Yep.
Companies have been reducing, if not all but eliminating, I worked for XYZ company for 30 years, now they're going to give me so much. Not a lot of new companies are doing that.
Yep.
So what that puts the onus on you to actually save more, to keep adding that third amount in there. And again, we did another slide. The average income at 65 of a house was about $50,000.
Right.
We have clients that say $50,000. I don't want to know $50,000. I want to know 100,000.
150.
Great. That probably means you're going to have to save more.
Well, in that scenario, so that's a good point. The Social Security is going to be a much smaller piece of the pie.
Correct.
What's going to grow is the investment section, which could be investments outside of retirement accounts.
Right.
Could also be real estate investments, and then you have your 401ks, your IRAs, your Roth IRAs. That component is going to be a much larger piece of the pie in that scenario.
That's exactly right. So let's take a look at some of the individual subcomponents. So let's start with Social Security, which a lot of people know about. Okay. So as we look at Social Security, this has historically been the most common form of reliable income in retirement. Now I use the word historically. If you hear the news or you read economic news today, Social Security is being looked at very closely because it wasn't initially created and designed to be the source of retirement income for the rest of your life. Okay?
Yeah, that, and when it was created, most people were dying at age 65.
Right.
And Social Security starts around 65.
That's exactly right.
Now people are living to 80 plus.
Right.
So it's got to last a lot longer, and you have a lot fewer workers putting into it.
Right. So there's some revamping that they're looking into Congress people to see how to make it last, because at the current rate, it's not going to last. Okay. But in general, historically has been, to qualify you have to work at least 10 years and pay into the system. Okay. As I mentioned earlier, I don't know if it was this video or another video, but currently if you're paying into it, you're probably paying for someone to actually use it today. So again, the whole revamping element.
Well, and a point to make on that is that paying into it means, sometimes people work as a server or some type of job that earns a lot of tips.
Right.
If you're not claiming those tips, then that's not really contributing more to your Social Security, and it could affect your long-term Social Security there.
That's exactly right. Now, the amount of Social Security you get is based on, it's an average of your highest earning years. So typically about 30 days before your birthday, and you don't have to wait, you can go online and create a Social Security account and see what it is, but you get a statement and it shows every year what you've earned, or at least what they have on record that you've earned, and how your Social Security is calculated, what the numbers are, okay? And then the other element is you can choose when you claim Social Security. So there's a range. You can either start at 62 or go as high as 70, okay, to claim. And the longer you wait, the more you get. And some people say, well, should I wait? Well, that depends. Okay, this is why I say go get a financial plan. Okay, but some people say, well, I'm going to take it all as much as possible. Well, that could be good, but that could be not good, because if you wait, every year that you wait is an 8% growth automatically guaranteed, and that, you can't guarantee that today in this market anywhere. Guaranteed, never. Okay, so that's pretty good growth rate if your portfolio and your plan allows for that to happen.
There is some tax considerations too the earlier you take it, which is important to kind of remember as well.
Right, the earlier you take it, tax, and if you're working, as we talked about, working is one of the elements of income. It can make your Social Security become taxable. We're going to have a whole lesson on Social Security, but Social Security is one of the income elements to consider. Another element is pensions. Okay. Historically, there were private pensions, and then government employees have pensions that the longer, it's a formula, the longer you wait, and there's a percentage of your earning years, etc. Okay, so what it is, it's a form of deferred compensation that's offered by your employer, and you pay into a pool of funds, and over time get a benefit at retirement. Okay, so the important thing here to understand is typically you have a choice of how you take this money. Some allow you to take the whole amount that's been accumulated and paid into and roll it out into your personal IRA.
Which that's usually called the lump sum.
The lump sum option. That is not the income option. That's a rollover option. We'll have another lesson on that, okay? But the income option is called annuitization. You annuitize, where you basically they'll take your lump sum and give you every month a amount of money. That's what annuitization means in essence, okay? And we'll define that, okay? But you have a choice sometimes of, do I take X amount and then when I die it goes away? Or do I take a lesser amount because I'm married, and if I'm married, the lesser amount will continue upon my death for her or him, okay, depending on who you are. So these are important choices. Obviously, what the right choice is depends on your financial structure, etc. But important that you're aware of these issues, because when you get that statement, there's all these numbers, you're like, what in the world is, it can be very confusing, but that's what they're saying is you have choices, okay? So that's what I just finished explaining. It's called a survivor benefit. Okay, so your pension plan may offer that. However, please know that a lot of private pensions are disappearing. Again, they're going away. Companies are not focusing their resources on providing you a pension anymore.
Yeah, they're not as common anymore. And the other thing that is somewhat rare too with pensions, but some of them do have it, is the cost of living adjustment, or what they call a COLA. So that will adjust every year, you know, based on a certain percentage, but it's meant to kind of help for inflation over time.
And that's another consideration to take into account when you're forecasting for your financial freedom. We talked about the power of inflation, either for or against you. You know, and if it doesn't have a COLA, well, that's working against you. So you have to take that into consideration. So that's a pension. Another possible income stream are called annuities. And an annuity is a contract that's purchased through an insurance company to secure some type of current or future income stream. Okay, so what happens, you may pay a lump sum, or over time pay X amount that accumulates to lump sum, and then you trigger this thing called annuitization. You annuitize, which is the opposite of actually taking the lump sum out, which is sometimes an option, okay, but the non-option is annuitization. And what you're basically doing is you're converting that lump sum of money into telling the insurance company, okay, based on whatever interest rate you can give me right now, usually not very competitive interest rates, but you know, 2, 3, whatever it is, they'll say, we're going to give you this much money for an X amount of time. You get to choose. I want it for X amount of period. Usually it's like 10-year period, or lifetime, or me plus some people, okay, which is again that survivor benefit, okay. You have these choices. The more you want to put the risk on them, the lower the benefit. So if you want to make it lifetime, it's going to be lower than if you say 5-year guaranteed or 10-year guaranteed, okay,
or no guarantee.
Or no guarantee. So the kicker to understand here is that when you annuitize, you're basically typically giving up the lump sum. You're saying, okay, you take and keep the lump sum for the promise to pay me an annuity for whatever term you know, and sometimes annuitization is great if you live really, really long. Not so great if you annuitize and then you don't live that long.
And at that point you also take away your flexibility too. Once you annuitize it, a lot of times you can't pull from that kind of lump sum anymore. So you know, it turns into kind of like a pension. And it comes every month, and
And why does Jason point this out? Not because we want to dissuade anybody from annuitizing or not, because just understand the pros and cons of each of these decisions as we look at the possible income streams, okay? And the last income stream that we talked about was earned income. More and more people are working. As we're living longer, they're finding themselves either working longer, okay, or shifting gears and at retirement, finding a different job. Okay, and sometimes you work at your local church or you work at a nonprofit or whatever. So there's some options here as far as whether it be need or boredom or a combination thereof that you can think about. Here's some examples. Work doing something you love, either teaching or consulting or making arts and crafts or some other form of business, okay? Well, one of my best friend's parents, they actually, is interesting, they shifted gears later in life and actually did a lot better with that than they were doing before they retired, if you will, okay? So that's another form of income stream that could be created in financial freedom. Now, we didn't talk about one piece, which is income accumulated from assets, okay? We're very purposeful about that because these are the ones that you typically can't control, okay? Social Security, annuitization. We're gonna, in another lesson, talk about accumulated assets and what that could look like as far as creating an income stream, okay? So as we've gone over these possible income streams in financial freedom, it's important to understand that having multiple income sources provides greater stability because you have something you know you can count on, hopefully, for your financial freedom plan, and also it provides less of a drain on investments, okay? So the more income streams, less you have to accumulate. Now, you may or may not have access to some of these income streams, so it's important to consider your personal situation in determining how much you'll have, and therefore that'll fold over into how much you'll need to accumulate, okay? So we hope this helps, and we look forward to seeing you in the next lesson.